Let's work some exercises in Chapter 10. Chapter 10 is on liabilities. This is about current and non-current portions of long-term debt and the ability to take a long-term debt and properly categorize it into current and long-term. On December 1st of 2015, your company borrowed $15,000, a portion which will be paid on November 30th of each year. Specifically, the payments are going to be $2,000 in 2016, in 2017 $3,000, 2018 $4,000, and 2019 $6,000. And the question is, how is it going to look on the financial statements, not December 31st of 2015, but 2016 and 2015. So we're going to have to do 2 years. So the first step, I guess, for this would be to decide how much of this $15,000 would be due in each one of the years. And then we also need to take into account that if we do make our payments and we make our payments on time, that the liability, the total liability, will be going down. So we have total liability, which is reducing, and then we also have the fact that we are rotating or going forward, and therefore our current portion is going to change. So in 2015, as it says up there, we borrowed $15,000. So we have $15,000 in total liabilities December 31st of 2015, because our first payment is not going to be made until November 30th of 2016. On December 31st of 2015, our total amount is going to be $15,000. That first payment, which is made in 2016, is going to be $2,000. So out of the 15, $2,000 is the current portion. The remainder then would be long-term. Now if we assume that we made this payment in 2016, November 30th, then when we do our November 30th, our December 31st, 2016 financial statement, then after making the $2,000 payment, our total liability or total debt associated with this long-term debt is going to be $13,000. The $3,000 is what we're going to have to pay in November of 2017, which is clearly within a year of December 31st of 2016. So the $3,000 is going to be the current portion of long-term debt. And if $13,000 is the total debt as of December 31st of 2016, then we can come down to the $10,000. Now you could also go back and say that in 2016, the long-term debt would be that which is going to be paid in 2018 on November 30th and November 30th of 2019. That would be $4,000 plus $6,000, and you would still come back to the $10,000. So there's various ways to get at these numbers. The important thing is to understand that if the debt is paid on time, then the total debt balance will go down. And also it is kind of a rotating or moving along with the calendar, where you're looking ahead to see what will be paid within the next calendar year to get at your current portion. This is about recording your note from its time of inception on to maturity. And this is one of the problems where it's going to be very difficult for you to see the requirements and the solution. So you may want to refer back to the PowerPoints that are posted and print them out to look at them there. So Target Corporation has a familiar problem. They have to build up their inventory ahead of their holiday sales, and a lot of the holiday sales then are on credit, and when they get the cash collected, they're going to take the cash and pay off the debt that they incurred to build up this inventory. A lot of times companies will do this, and they will build up their inventories starting in the fall. They will put in their orders for merchandise. The merchandise will start coming in We know it needs to be stocked and be available for customers purchased by Black Friday, which is a Friday following Thanksgiving. And we also know that the company will have to pay for this if it's paid for with accounts payable. Usually the terms are 30 days after receipt of the merchandise. However, the customer is not going to buy the merchandise probably until late November or through December. And so the cash that's going to come in that the company's going to have is going to be delayed. So oftentimes the company will not only use accounts payable for credit, they'll also go out and take a promissory note to pay off the accounts payable, because accounts payable usually has a high interest rate if it's not paid on time. This case, Target went out in November 1st, so the accounts payable became due. They're going to pay off their accounts payable by on November 1st, borrowing $6 million cash from the bank with a note. And the note is going to mature in 6 months. In the 6 months time, they will have ample cash to pay it off, and also be able to pay off also the interest, which is 8%. And note here, it's a note that's an 8% interest. 8% will be the annual rate, and so if you wanted a rate for 6 months, it would be 4%. So on November 1st, when they take out the note, they're going to have several things happening. The first thing happening on November 1st is they're going to get the cash in, and they're going to record a liability. And also, if they were to do a monthly financial at November 30th, they would have to accrue interest. In this case, they're just asking us in for the adjusting journal entry December 31st. So it would be 2 months of interest, or 2/6 of 4%. Another way to look at it is 2/12 of 8% is going to be their interest expense and their interest payable that they need to accrue on December 31st. Then on the third entry, which is on the maturity date, April 30th of 2016, 6 months after they took out this note, they're going to have to pay the interest, which is all of the interest, and they are also going to have to remove part of that interest payable and record new interest expense. So to work through these things is on November 1st, taking out the note, recording this note, which is recorded properly as a short term because it's within 6 months. It's 6 months, it's within a year. And then at December 31st, they're going to have to record 2/12 of the 8%, which is the $80,000 as interest expense and interest payable. And then at the maturity date, you can either record this as 2 entries or you can record it as 1 entry. I think many of the other versions of this we have had 2 entries. If you did 2 entries, it would be a debit to note payable and a credit to cash of $6 million. And then it would be a debit to interest payable of $80,000, a debit to interest expense of $160,000, and a credit to cash of $240,000. If you combine it, it's this way, which is right here. Now technically, what I think will probably happen is that there will be a cash transfer, and the cash transfer will be done out of the bank account, 1 transaction, not 2, and it's going to be $6,240,000 in cash. So I believe technically doing it this way is probably the preferred way, but if it's easier for you to see it as 2 journal entries, as I have just discussed, then that's perfectly fine. The point we're making is we want to make sure that on April 30th there is a total removal of that note payable, there's a recording of interest expense, and there's a recording of interest payable that removes the balance we just put in interest payable on December 31st. Okay, and we also need to show cash coming out, a total amount of cash of $6,240,000. Now payroll. Here we have McLeod Company, and they have completed the salary and wage payroll for March. And in requirement 1, they ask us to do both employee and employer payroll. And so this is usually done as 2 journal entries, and we first take care of the employee. And when we take care of the employees, if we're paying it with cash, there will be a credit to cash. If we are not paying the cash, not cutting the checks, we'll also have a wages payable, salary and wages payable recorded. The second journal entry is the employer's portion of the payroll taxes. And remember that the employer has to pay the same amount of FICA as the withholding from the employee, and also they have to pay the unemployment taxes. So let's go into these. So salary and wages expense is the total gross amount of pay for their employees. They are taking income taxes and they're going to withhold these. Now, usually it doesn't say withheld income taxes payable. We just record our income taxes payable, and it's $37,000. We have the Social Security portion, which is taken out of the employee's paycheck, and that's $28,600. And the net is the cash, and this is the amount of the total checks that are cut. Then we also have to think about payroll tax expense. Again, we are going to match whatever is withheld from the employee for the FICA, which is Social Security. That creates this liability. And then we have unemployment taxes payable. As I pointed out to you before, there's usually a federal and a state portion, and we put them into separate taxes payable. And these combined are the payroll tax expense, and this is an expense of the company, an amount that the company will have to pay, and it also represents an expense which shows up on the income statement. Now here's bonds, and these bonds are issued at face value, which means there's no premium or discount, which means that when we record our bond liability and get the cash in, that amount is going to be the face value, or $200,000. It has a stated interest rate of 6%. This 6% is going to be per annum, and it's going to be for 10 years. So for 10 years, every year there's going to be 6%. With this particular example, it says they pay interest once a year. So at the end of the year, they're going to pay 6% of $200,000. Well, 6% of $100,000 would be $6,000, so I'm guessing this is $12,000 in interest every year. We also have to take note of the date. It's January 1st. So January 1st through the end of the year, that means January 1st, December 31st each year is the date on which they're going to pay the interest. So take out the bond, record it, face value, no discount, no premium in the first journal entry. The interest expense will be paid, and the interest expense is paid at the end of the year. Therefore, there's no need to accrue. There's no accrual entries because it's January 1st through December 31st. That's the interest payment period, and it is also the end of their fiscal year. So there's no accruals. No accruals are needed to be done in this one. And then at the end, we would take it off the books. Now, in this particular case, there's another component of it. Let me go back to the previous. And it says, the bonds were retired immediately after the first interest payment at a quoted price of 101. This means 101% of face value. And so they are going to retire the bonds. They're going to pay off their bonds after the first year. they already have paid that first interest payment on the bonds. So what they're going to do here is they're going to remove the bond at its face value, which is what it's carried at, and they're going to pay cash of 202, 101% of the 200,000. Because they're paying more than the liability, they're not paying 200,000, they're paying 202,000. The 2,000 represents a loss on the retirement of these bonds. Next, we're going to look at the ratios that need to be calculated associated with debt. And here we have the numbers for 2 years. In the first one, you have assets, you have liabilities, and you can assume by looking, if we wanted to, we could also calculate equity by taking assets minus liabilities, couldn't we? The other thing we're going to need to know is we're going to calculate EBIT, interest before earnings before interest and taxes. Earnings before interest and taxes means we have to add interest and we have to add net income to the, we have to add interest and income taxes to net income to get the EBIT number in our numerator, and our denominator is going to be interest expense. Now, debt to assets is the same as liabilities to assets, and these are calculations. And we can see that there's slightly more liabilities to assets in 2013 than 2012, so a slightly greater reliance upon liabilities in 2013. When we look at the times interest earned, we find that in 2013, though, the company is better able to make their interest payments than they were in 2012. We have some more current liabilities to record here, so it's just exercises related to recording these liabilities. In the first requirement, we have a payment of a payroll to our employees. Paying payroll, the gross wages goes to salary and wage expense, and the net amounts goes to cash if it's being paid in that time period. If it's not being paid, it would be wages and salaries payable instead of cash, and all the deductions represents liabilities to the company. And when we have to think about our portion of payroll taxes, we are going to match whatever FICA is for the employee, we match it, and we also have to pay state and federal unemployment taxes payable. This constitutes our total payroll expense. If we collect rent and we have done nothing to earn it, we record it as unearned, and then at the end of the time period we record a portion of it related to the number of days which have passed as earned as rent revenue and remove that unearned. So in this case we have 20 days which we have earned, and we have another 10 days which we haven't earned. So you could also look at the balance in the unearned revenue as of December 31st, and that would be 6,000 minus 4,000, or 2,000. On our balance sheet, we show all sorts of current liabilities. I believe we had a slide in the PowerPoints that said accrued liabilities, see exhibit. Well, this would be a sort of discussion of it, a listing of what the particular items are for. And all of these are going to be amounts that we're going to have to pay within the next year, probably within the next 6 months even, and they show up in the current liability section.